is Danielle Shay, and today we're going to be going through Butterflies 101. So I'm Danielle Shay. Like I said, I'm the VP of Options at Simpler Trading. You can find me in our trading room. I also have my own options picking service, and I'm a frequent guest in the media, CNBC, Fox Business, and of course, StockCharts. So today we're going to be talking about butterflies. We're talking about butterflies because, well, I love butterflies and it's one of my absolute favorite strategies. Now, normally at any given time, I would say around 60% or so of my positions are going to be butterflies. Now, people always say, why do you do that? Well, there's a couple different reasons. Number one, when I started off trading, I was trading with a small account. There was a lot of different tickers that I was not able to buy directional long calls on. Just take Amazon, Google, Netflix, Tesla, for example. One single long call on any of these tickers is going to cost you thousands of dollars, and it's going to be incredibly volatile as well. So what I wanted to do was I wanted to figure out a way that I could trade options where I could get in at a reasonable price point, have a great risk to reward, and still be able to trade directional moves, because I love trading directional moves. That means I'm looking for the stock to go from here to here, and I wanted to find a way to capitalize on that. Now, because of all of those reasons, I started learning how to trade butterflies, and now it's really my number one strategy. So this is what we're going to be going through today. So really, these are going to be my secret weapon when it comes to growing small accounts. People will always ask me too, well, can I use this with a larger account? Of course you can use it with a larger account. But the reason why I like these in particular is because I can put on trades for as little as 50 cents, $1, $1.50. That's going to be as low as $50, okay? Now, normally my trades aren't that small. I generally do keep them around anywhere between $5 to about $15, which is going to equate to $500 to $1,500 per contract in the options market. But just know that with the butterfly strategy, what you're doing is you're essentially cutting down the cost of your long call significantly. And because of that, you can put on trades for, $50 to $100. So that's one of the primary reasons. The other reason why I like butterflies is because they hold their value really well through volatility. A lot of people, they get into the options market and they just cannot believe how quickly options move. Now, with a butterfly strategy, because you have multiple legs, that means that you're going to be long and short at different strike prices at the same time. They're going to hold up a lot better through volatility. That's because if the market's going down, it's not really going in your favor. You do have a short strike that's working for you, even though your long strikes may be working against you. So it does tend to hold up a lot better, especially in some of these crazy market times. Typically with these trades, I get about a 1 to 4 risk reward ratio. That means I'm risking 1 to make a maximum of 4. Now, depending on how you set up your butterflies, that can be more and it can be less. You can risk 1 to make a maximum of 2. You can risk 1 to make a maximum of 25. It just all depends on how wide your butterflies are, if they're in the money, if they're out of the money. But the moral of the story is that this strategy is open to a really wide range of traders because, some folks might like to do a really wide fly that's a little bit more expensive, that has a little bit more profit potential, and some folks might like to do a smaller butterfly that is going to cost less and it has less profit potential. But once you learn how to use the strategy, you can do it however you want. So the main reason and the main way that I trade these is going to be in a directional manner. Now, a lot of people come to me and they say that they've been following someone else who trades it in a neutral manner. Everything that I do is directional. So here's just an example of a way that I'm going to place a butterfly. So let's pretend that your current stock price is right around here, and I'm looking at a trending chart, okay? That's because I pretty much always trade with the trend. There are some exceptions to that, of course, depending on volatility, but let's just pretend you're looking at a trending chart. So on a trending chart, you're going to have, price pulling up, pulls back on a dip, and then it goes up to a new extension. For those of you who use Fibonacci extension targets, this is a pretty typical way to look at a way that you would determine fib targets. You have a previous high, you have a dip, this would be a 100% move. Then you have some resistance and you have a full target up here. So essentially what I'm doing when I'm placing an options trade like this is I'm using a multi-leg strategy. It's called a multi-leg strategy because there's going to be more than one leg. On a long call, for example, you would really just buy one long call, and people will either do that at the money, out of the money, or in the money. But once you buy that long call, you know, you're spending a debit, and well, you just gotta wait and see if it works. When I do buy long calls, but I really only do it maybe like 20 to 30% of the time, because I find that the multi-leg strategies work a lot better the majority of the time. There are moments in time where you want to buy a long call, for example, when the market's really strong to the upside. But for the most part, I find that butterflies are going to work a little bit better the majority of the time. So for example, let's say let's say it's Tesla, okay? Let's say we're looking at Tesla and Tesla's right around $700. Now let's pretend we wanted to buy a $700 call. Okay, that call is going to be incredibly expensive. I can actually go to my options chain right now and see what it would be. Let's just use next week, for example. So a long call on Tesla right at this moment in time. And let me take my drawing tool off here. So a long call on Tesla, just right at the money at the $700 strike, is going to put you back about $2,600 a contract. So pretty pricey, right? It's going to be expensive, but if you have a larger account, you can do it. Not so if you have a smaller account. So one way that you can make that trade a lot cheaper and be able to get into it is by creating a butterfly. So what you do is, instead of just buying the $700 call, you create a butterfly where you have one $700 long call, then you have two short strikes higher up on your options chain, and you have another long strike up here. What this does is it creates a strategy where you are paying a debit for the 700, but then you're selling two higher calls up here. You're doing it in the same expiration series. They're just going to be further up the options chain, so they're going to be out of the money. When you sell those two calls, what you do is you bring down the cost of this debit, because you're buying this for a debit and selling these for a credit. Now, the third piece of the butterfly is the leg that's up at the top. So you do want to add that third strike, because that is how you get a defined risk strategy. You can leave that strike off, but then what happens is you're long one and short two, and you have unlimited risks to the upside, which is not something that I want to get into. So by placing another strike right up here at the top, you are now long two and short two, but the idea is that you're short these two strikes that are ideally going to stay out of the money. You're picking a long call that's ideally going to gain in value. You're picking two short calls that are ideally going to decay over time, therefore making you money. And this one is just a third strike that you're adding for protection. So basically, when you're setting up a butterfly like this, normally how I set up my butterflies, and I do them in a variety of different ways. People will always email me and say, well, which is it? Is it in the money? Is it at the money? Is it out of the money? My answer is that it just depends. It depends on what the price of the butterfly is. It depends on how directional I am. With something like Tesla, typically what I do is I'll get into an out of the money butterfly. The reason for that is because they're expensive. The in the money calls, the at the money calls are expensive. So for example, on this Tesla fly that I just entered, I think I got into it on Friday. I think Tesla was trading around 675 at the time. And basically what I did was I looked at my chart here. And what I'm looking for is I'm looking for a target zone to the upside, because your center strike needs to be right around a target zone. And you want the ticker to go up into the zone, but not through it. So essentially, I was looking at the fact that we have a squeeze here, which is a consolidation setup that's about to break out. We also have volume that's coming into the stock. We also have a key psychological value right here that is just above where we're currently trading. So what I decided to do was I decided to get in to a bullish butterfly on Tesla. I bought the 700s, I sold the 750s, and then I bought the 800s. Now today, Tesla is up, what, 3.4%. And so what's happened is that I paid $8.65 instead of paying $2,600. And I now have a butterfly that's up, what, almost $3 or so. And the idea is that as Tesla trades into the 750 zone, that butterfly will just continue to mature or kind of go up in value. So right now, I mean, I just put this on. One of the main reasons why I put it on is because it has earnings coming up, and Tesla has a statistical likelihood of trading higher going into this earnings report. I also put that on because the NASDAQ has been breaking out. So we had the NASDAQ that was consolidating, and then boom, all of a sudden we had a major tech breakout going into the core of tech earnings. So I'm going to show you a couple other trades that I put on with these butterflies. So for me, I always use them as a directional trade. You're going to have to ask somebody else if they use them in a neutral manner. I know people will use them, for example, really wide on the indexes and just wait right around the center strike while price just chops around. That's just not what I do. I do it just like this, okay? So I'm looking for a ticker that's likely to move. I need for it to have a range that it's going to trade into. So I need price to be away from the range that I think it's going to get to. That's what makes it directional. So if we're trading down here, I've identified a range up here. I want the stock to go from here to here so that that long call on the bottom is going to rise going into that stack profit zone. And ideally, that center strike stays out of the money. So you also need for price to be away from where you're targeting. So people will always ask me, hey, Danielle, Apple's trading at 135. Can I make a 135 butterfly? Not in the way that I trade it, because you're already at your target zone. If, however, you said, hey, Danielle, Apple's at 135 and I'm targeting 150, is that a good butterfly? I would say yes, if you're, targeting a higher area and you have a confluence of a technical setup along with some targets. Now, Apple right now is a little bit, it has already broken out, so I'm not actually going to put that trade on. I'm just trying to give you an example. So you also need to identify a key area of resistance, because you don't want that fly to trade up through that area of resistance. And that area of resistance is typically going to be your price target. So how do you place the trades? Well, I use a combination of charts and then the options chain as well. So the first thing that I'm looking at is going to be my charts. I need my charts so that I can identify the key target zone, or else I don't have a trade, right? So on my charts, I'm going to use Fibonacci analysis, key moving averages, squeezes, which are consolidation breakouts, volume, and top-down analysis. So to identify my trades, normally I'm going to start with the overall indexes, and then I'm going to narrow that down and say, okay, which sector is likely to break out? Okay, I think tech's likely to break out going into earnings. Okay, let me trade Tesla and Apple, Amazon. So that's what I mean by the top-down analysis. So the technical analysis is going to be coupled with factors in your options chain. It seems complicated, but it's really not that hard, because once you learn it, they start to just stick out to you like a sore thumb. So we're looking for key psychological values, any big round numbers. We're also looking for high open interest. This is just demonstrating there's a lot of action at that option strike. And we're looking for the expected move. Is it reasonable for that stock to get to that price by the expiration date that we have selected? So these are typically the values that I look at on my options chain. I have delta, strike, in the money, at the money, calls or puts, implied volatility, volume, or open interest. So here's just a couple examples of trades that I had on this week. I was looking at Apple, and I was looking at Apple for the potential for it to break out above the 50 simple and above this key area of resistance. And I had identified a target zone up here at about 135. I also have my hot zone tool that demonstrates that Apple typically does break out higher prior to its earnings report. So I went ahead and placed a butterfly targeting this 135 zone. On this chart, you can see a little bit better the areas of resistance that I've drawn. Those are Fibonacci areas. And basically I was betting on it sticking within the 132 to 140 range. So when you look at the options chain, it becomes a lot more clear because you can see that there's a ton of call volume happening right here at the 135 strike, okay? You're looking for a strike that has, 3 times the normal volume than all the other strikes. So I went ahead and set up that butterfly. This one was super cheap. And the reason why I did this one so cheap was because it was more of a lotto trade. I don't normally like to get into breakout trades because I like to get in before the breakout. That's how I get a much better risk to reward. So when I'm trading a breakout, I will do it kind of cheap. So this trade was only 69 bucks per contract. And I ended up getting out of that for 2.5 times, the debit that I paid. So Apple did end up breaking out, and along with it went Amazon. So Amazon was one that I wanted to trade as well. I used these Fibonacci levels up here, 3,300 and then 3,400, and overlap those with those key psychological values, and went ahead and put 2 different trades on this one for Amazon. So on Amazon, when you can see, this is what eventually happened. This chart is just from I just took the screenshot right before this presentation, but basically it traveled right up into a key area of price resistance. It was very close to that 3,400 price point. I think the tick was actually like 33.98 or something like that. So you can check that out because that just happened today. But the way that I traded it was with 2 different butterflies. So I had one butterfly, you can see down here, it was $50 wide. So it was $32.50, $3,300, and then $33.50. So I put this on when this strike was out of the money, and I just waited until it traded up into my middle zone. And, I got in for 690, got out for 980. So that was about a 50% winner. So not bad. Normally on calls, I'm looking for like 25 to 50%, and butterflies, 50% is kind of the low end of the range. The reason why it wasn't more was just because it still had some time left on the trade. So I had a 3,300 fly, and then I also had a 3,400 fly. So this trade I just took off this morning, got in for 323, out for 457, and I was only in there for 2 days. But again, it was an overlap of that key psychological value with the fib level. Now you might ask, well, how could you make more money on it? Well, the way that you make more money on it is you get the price directly to that center strike the day of expiration. And that's what we would call a perfect pin. Now, one criticism that I always get from people is they say, oh, well, you're never going to make money on a butterfly unless you get it to the exact date and the exact time. Well, I've done it a couple times. I mean, usually every other month, maybe every 3rd month or so, I'll get a perfect one, which is amazing, because if you get that, that's when you buy something for 323 and you can sell it for 50 bucks. Those are huge trades. But you don't need for that to happen to make money on it. All you need is for the price to come up into your range. So for example, the range was 3360 to 3,400. So you can still make money in like 50% to 100%, 200% winners. I mean, it's nothing to sneeze at, even though, of course, getting in for 3 and getting out for 50 would be amazing. What we're looking for is regular, steady winners. So essentially, when you're looking for a butterfly to make money, you want it to trade up into that center strike, which is what I like to call the stack profit zone. You can widen your butterflies out however you want. Typically on the larger stocks, I'm going to make it a little bit wider. Sometimes, like on Apple, you saw that butterfly was pretty tight. The smaller they are, the cheaper they're going to be, and the harder it is to get it to that center strike because your range is smaller. the easier, it's going to be easier the more it is and the wider your range is. So I get this question a lot as well. You know, hey Danielle, how do you close your butterflies? Well, usually I use a couple different variables. Number one, in the Amazon and Apple examples, I close it when it gets to the center strike because that's the target. If you don't close it when it gets to the center strike, and like, let's say that you still have 2 or 3 weeks on your trade, the more likely scenario is that it's going to blow through your center strike. And then that's where you can start losing money. So the way you're going to lose money is either A, if your butterfly doesn't ever move from A to B, your debit is just going to decay. Or B, if you actually put your center strike a little bit too close and the ticker trades right through it. So for that reason, I like to close them when they get to the center strike. I also will close them if it's a double or a triple because, well, I mean, why not? You need to take your money off the table. So there's going to be times where, you know, I have a trade on and it's not quite to my center strike yet, but I have a double or I have a triple. So I'm going to take my money and run. I will also close them if I had a stop loss level. So sometimes I'll use a 50% stop on some of the larger flies, but the smaller flies, I usually just let them ride. And if it doesn't work out, then I will end up losing my debit. And then the last reason that I will close it is if it's running out of time and it's just not going to get there in time. So what has happened lately, especially in the volatility, if you place a butterfly right out of the money, and then the market pulls back, well, now you have something that's really out of the money. So if you need to close that out and place another one with a lower target, then you can also do that. So the moral of the story is that the butterfly formula is pretty simple. You got to pick your stock. You need to find a directional setup. That means you need to have a reason that you think the stock is going to move. You need to identify key levels of support and resistance, be thoughtful of your time frame, and select your strikes using your options chain. So there are going to be times where I do not use butterflies. I don't use them when there is not enough liquidity in the strikes. Some people will say, hey, you know, there's no contracts here or the spreads are really wide. Well, it's because you can't use a butterfly then. So you do really need to stick with liquid stocks, especially stocks that are highly traded in the options market. If I can't get one about 3 weeks out, I don't usually like to do it because I'm a shorter term momentum trader. I like my trades to last anywhere between 1 day and 3 weeks. So if you're asking me about a target on John Deere that's out in July, it's just going to take forever for that butterfly to mature. You can definitely do it if you're a longer term trader, but to me, I get a little bored. So I like to get those in and out trades on those moves that last in less than 3 weeks. So you can also skip a butterfly when a debit spread would be the exact same cost. The reason why you're doing a butterfly is so it's cheaper to begin with. So if you're doing a butterfly and you have a long leg here, and then you have your short legs here, and you have another long leg here, and your fly is going to cost the same as a debit spread, there's just no reason to do the butterfly instead. I also never place them the same week of earnings because you don't want to place them in a rising volatility environment because the short strikes will start to go against you. And you don't want to place a butterfly when your price is already too close, where your target price is too close to the price that the stock is currently trading. So if you want to learn more, you can find me in a variety of locations. I have a free newsletter, 5startrader.com. That's FIVE. You can also follow me on Twitter. If you have any questions from this presentation, you can tweet me at Trader Danielle. I'm pretty active on there. I do also have my own options picking service where I post tons of butterfly trades. It's called the Stack Profits Mastery, which I'm sure you can also find on my Twitter or at simplertrading.com. And you can find me here, of course. So if you want to learn more, I did just do a free webinar. This is the link to it. You just go ahead and type that into your Chrome or whatever platform that you use for the internet. You can find a 1 hour long recording of a free webinar that I actually just did last Wednesday. And this includes a ton of different trades that I'm looking at, primarily focusing on the run into earnings. So it's really awesome. Thank you so much, StockCharts, for having me. Again, you can follow me on Twitter at Trader Danielle, and that's about it. Thank you very much.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.